It's time, folks. So welcome back. And just a reminder that your second quiz is a week from today. I know you haven't even been thinking about it, but your next quiz will be a week from today. And I'll send out an email, telling you which pages it covers. It covers everything from cash flows, which is where we left off the last quiz, through growth rates, terminal value, loose ends, a lot of details. But basically, that's what the second quiz will cover, and it'll be all available just like the first quiz for a big chunk of next Wednesday. And I'll send you the review session and the quizzes to go with it. Any questions or before we start? Okay, so last session we were talking about storytelling and how critical it is to understand the story behind your company. So today's test, we're going to start with that storytelling, and I'm going to kind of ask you to help me kind of flesh out more on this concept. So let's talk about how every Excel spreadsheet, every valuation tells a story. So you're going to be my, help me out here. So let's assume that I'm an analyst. I valued a company, and all you have is an Excel spreadsheet in front of me. You've never heard of the company before, but you're seeing my Excel spreadsheet. And here's what I'm using. I'm using a 50% growth rate in revenues for the next 10 years, compounded. Right? I'm using an operating margin of 20% in year 10, twice the industry average. I'm also assuming that they have very low reinvestment. They throw a sales to cap ratio, they're investing very little. And the cost of capital I have in dollar terms is 7%. When you compare to the rest of companies, that's well below what a typical company's cost of capital is. So it's an Excel spreadsheet of growth, margins, reinvestment, cost of capital. On each of the following dimensions, I want you to tell me what some of these are going to be easier than others. What am I telling you something about the company size? Is my story a big company story or a small company story? What gives it away?
I mean, well, there are aspects that imply both a small company and a big company, like the growth rate. That's more characteristic of a small company.
But once you do the growth rate, what happens to my company? So my story, the story is about my end game, right? Story is not about where I'm starting, it's about where I'm ending. So if I'm telling you about where I'm ending, if I use a 50% revenue growth rate for the next 10 years, I'm going to make whatever company I start with into a big company. Right, so it's a big company story. You're saying, so what? The market they have to go after must also then be a big market. So you want to check that, right? Am I telling you anything about the company's competitive advantages, the numbers that I'm using?
I mean, the cost of capital is below the average, so that means maybe it has an advantage or differentiating factor that gives it more stability in a sense, perhaps.
Well, that has to show up either as a lower beta, which would be tough to do because betas come from the business you're in. So cost of capital is actually very difficult to change for a company. It's a market set number. But if I have competitive advantages, what does it allow me to do? Either charge a higher prices or sell more. The margins that I'm assuming are much higher than mine does. So only way you do that is by having some kind of competitive edge. And am I telling you anything about the capital intensity of the business? What am I telling you about reinvestment?
They're not investing as much as into their business.
So basically, implicitly, I'm saying this must be a capital light business. And I'm also am I telling you anything about the product or service, whether it's discretionary, non-discretionary? What kind of gives that away?
I think going back to the cost of capital, since it's below the average, maybe it would be non-discretionary.
Exactly, right? Right, because if I was selling luxury products, I don't care how well I'm run or how good a company I am, my cost of capital is going to reflect it. You see where I'm going? I'm telling you a story of a company that's going to grow over time with significant competitive advantages in a growing market while not reinvesting very much and selling a product that is non-discretionary. So you know what you need to do is go check to see whether my company fits the bill, because I might be just making up stuff. What I'm trying to say is when you do see a DCF, that's what you're backing into, is what am I assuming about the company and is that fair? So when you tell, every valuation you give has a story embedded in it, right? And that story might change. So Shari, let me ask you a question. Let's think about things that could cause them to change. Could an earnings report for a company change your story for the company?
Probably because like some of the data that we use isn't like accurate. So earnings report from the company, we can actually change the numbers on the DCF.
Yeah, but is that what, because I could give you a slightly different revenue or a slightly different earnings per share, but that's really not changing my story much, right? So
It's
it
not
has to be
changing.
something else in the report where I say, I've entered this new business or I've dropped out of this business or I'm entering a country, which, so it's actually not the numbers in the earnings report that you're looking at, it's the rest of what the company reveals.
Mhm.
It could change your story.
Yeah.
Today, the Federal Open Market Committee is meeting. You've probably been reading news stories about what Jerome Powell is saying. If he says something shocking about inflation, could that change your story?
Yeah.
Absolutely. The stimulus plan passing last week changes your story, right? If you're a consumer product company, this is the kind of product. Regulatory changes could change your story. If you're a company that's driven by regulations, even earnings reports from other companies can change your story. Do you see why? If you're an electric car company and other automobile companies report surges in electric car sales, I might say, you know what, people are buying more electric cars, so I'm going to push up your revenues too. This is exceptionally bad news for you guys. You know why? Because you're going to tell a story about your company and you're going to turn it in on April 2nd, and I'm going to tell you the story makes sense, but that story is not done. There are other things that will happen between April and May. And on May 10th, when you turn in your evaluation and your recommendation, it's not forever. Things can change. And finally, Rodrigo, you can help me on this one. Remember the concept of corporate life cycle? I introduced it, I think, in the first class. So young companies, startups, then you have toddler companies, then you have teenage companies, then you have companies at the peak of their lives, then you get middle-aged, then you get old, and then you die. And you value companies across the life cycle. And valuing companies use a mix of stuff, right? You mix a mix of earnings and past financials and numbers and stories about the company. We listen to what the management says about the future. Do you think that mix will change as companies go through the life cycle of how much story and how much number?
In terms of growth, that changes. Also, the discount rate. Uh, and in terms of margins as well.
So basically saying every part. So
Everything.
tell me what will change. So if you're valuing a young company, what are you drawing on more, numbers or story? What do you start with? Now value.
Yeah,
Go
start with story, like assigning a potential market size.
And why did I have to start with the story with Uber? Why didn't I go look at the numbers?
Because Uber, you can tell a huge global story or you can tell a local.
And also, there were no numbers to look at, right? So even if I'd looked at the numbers, is Roger here? I mean, basically, some of you are valuing young companies. Now, when you're valuing a company that's young, even if I gave you financials, nothing in those financials really tell you very much about the future. It's all story that's driving your revenue growth, your margins, your reinvestment. In contrast, if I gave you Coca-Cola, you're much more dependent on numbers, right? I give you history, you can draw on the numbers. The dependence on stories and numbers shifts over the life of a company. And I'll give you an analogy that I think best reflects the shift. Now, sometimes you have these well-known authors, they write bestsellers, and then they're in the middle of a book and they die. It's a very morbid story. And then they bring in somebody else to finish the book. This happened with that dragon tattoo. Remember the girl with the dragon tattoo series that's been made a movie? There were like 3 books. There were supposed to be 3 books, but in the middle of the 3rd book, the author died and they brought in somebody else to finish the book. So let's say you're a writer and I'm a publisher. And this is a very morbid story, so hang in there. And I have a book being written by a well-known author. You can give the author a name, Stephen, whoever your favorite author is. You've read a lot of their books and you know how they write. James Patterson, but I don't think James Patterson actually writes a book. I think he has this computer that churns out, because he churns out a book like at every 2 weeks or 4 weeks. No. And he dies in the middle of writing the book. So the publisher calls you and he says, look, we'd like you to finish the book. Let's suppose that the person writing the book died while he was writing chapter 1 of the book. And this is a 30-chapter book. And you get to finish the book. You can tell a lot of different stories, right? Because you're not bound. There's not much there that binds you. You can create new characters. You can make the story go off in new lines. You could bring you have lots of freedom to tell a story. In contrast, when I call you, I say, look, this guy died. He was writing chapter 29 of a 30-chapter book. Can you come in and finish the last 2 chapters? There's not a whole lot you can do that's different because the story's already been told. When you value an Uber, you're in chapter 1 of a very long story. That's why your story and mine can be very different. When you value Coca-Cola, you're in chapter 28, maybe even chapter 29 of a 30-chapter story. So if I told you a story of Coca-Cola, a software company that makes technology, you know what your answer is going to be? That is not going to work. You're a beverage company. I can see it right here. So when you tell stories, the reason I bring this up is when I wrote my book, Narrative and Numbers, in 2017 about telling stories, people said, well, people have been doing valuation forever. How come we never needed stories? I mean, I wrote the first edition of my book I started writing in 1990. And in 1990, you know what companies people valued in public markets? Usually mature companies making money. So my valuation book is all about numbers because you could get away taking numbers, doing ratios, doing all kinds of great stuff. But in the late 90s, I ran into a problem, which is I was asked to value Amazon. I took my own book and I tried to apply it, and it wasn't working. I had to teach myself storytelling precisely because of that reason. So for those of you valuing younger companies, get ready to tell a story because that's really where your valuation begins. If you're valuing a mature company and the story's been pretty much told, you can get away doing past data and ratios and doing all that neat stuff. But the mix of stories and numbers will change as a company ages. So let me take you back to where I left you on the Uber story. Remember the Uber? Go ahead, Joe.
I was just wondering if there's a way to quantify the impact that a good story has on evaluation. So, for example, like when you were valuing Amazon, I'm sure like
What are the 3 places the story plays out? Growth, margins, and sales to capital. A good story, what are going to be the characteristics? You're going to have high growth, high margins, low sales to capital. So basically the place it plays out is through those 3 numbers. So when you talk about good stories, average stories, and bad stories, those levers are sufficient to pretty much put in any story you have for a company. And you want to stay focused because if you let the story distract you, you're going to wander off into fantasy land. And that's why I spent so much time asking, is this story possible, plausible, probable? Because once I've done that, then I can do the dirty work of converting into numbers.
Got it.
So I left you the Uber. Where was I in my Uber story? I told a story about Uber as an urban car service company attracting new users with local networking benefits. I checked to make sure the story is possible, plausible, probable. And then I left you the cautionary note. Be very careful about stories that you really want to come true, because then you stop asking questions. So now I'm going to talk a couple more examples of where your stories can go off the tracks. Once in a while, you might think you're telling a plausible story, and you might be, but you could be fooling yourself because you're missing the fact there are other people telling stories just like yours. Let me back up. Let's assume you're looking at a big market. Big market like what? Artificial intelligence. It could be electric cars, right? Big market out there. You can see it's attractive, you know. And you're an entrepreneur and you want to take advantage of the big market. Are any of you entrepreneurs? Do you have your own business? Anybody? You at least know entrepreneurs, right? You've met them. Let me ask you a question about entrepreneurs. Mohammed, you're an entrepreneur?
Sort of, I guess.
You're starting a business?
Yeah, I just started an ed tech platform
Okay.
based out
And
of
did that require a lot of
Pakistan, India.
courage to start a business?
It definitely does, I guess, because I mean the resources that you're trying to use, if it doesn't work out, then you lose all of.
Yeah. So let me ask you a generic question about entrepreneurs. Do entrepreneurs in general tend to be overconfident people or diffident people? What do you have to be an entrepreneur? Mohammed, you can stay on. What do you have to be? Overconfident or diffident?
I guess you have to be overconfident.
You have
To
to be
a certain extent.
overconfident, not just confident, but overconfident, right? Because that's what allows you to take that leap. I can pull this off. So you see a big market, you decide you're going to exploit it, you start a business to exploit that big market. Then what do you need? You need capital. So you approach venture capitalists. Let me ask you a generic question about venture capitalists. Do they tend to be diffident, reserved people, or do they tend to be overconfident, boisterous people? You've seen Shark Tank, right? Mark Cuban looks like a very shy person. He probably doesn't tell you what's on his mind. How about Kevin O'Leary? Venture capitalists also tend to be overconfident people, overconfident, their capacity to pick winners in terms of, finding. So Mohammed starts a business, he finds 3 venture capitalists. So as an overconfident entrepreneur, you're supplied capital by 3 overconfident venture capitalists, and you go after the big market. And you're not the only one seeing the big market. Imagine 100 clusters like yours all over Silicon Valley. They all see the big market. They're all creating these clusters, and within each cluster, there's an overconfident entrepreneur and 3 overconfident venture capitalists. Do you see what's going to happen? Each cluster thinks it's going to win the game. So when you look at their projections, they're projecting big revenues, winning margins, high value. But here's the bottom line. The market is not big enough for all 100 to win. In fact, if I added up the revenue projections of all 100 companies, you know what I'm going to find? That the collective revenues of these 100 companies is well in excess of the actual market. I did this in 2016 when I looked at social media companies, which all claimed to be going after the online advertising market. And I concluded that the collective revenues you'd need to justify what these companies were trading at had to be 2 times larger than the actual market. Today, you see this with electric cars, right? You ask somebody investing in Tesla, why they're investing in Tesla. What do they say? Because electric cars are the future. You ask somebody investing in NIO, why are you investing in NIO? Because electric cars are the future. You ask somebody investing in Nikola, why are you investing in Nikola? Because electric cars are the future. Now, there's nothing wrong with the base story, but they're all going after the same market. And to the extent that that market has limits on how big it is, they can't all win. I call this the big market delusion. And the bigger the market, the more this is not the first time this has happened. In the 1980s, you know what the big market was? PCs. Everybody could see that the PC market was going to explode. Everybody's going to buy PCs. And they were right. And there were dozens of PC companies in the early 80s that had high market caps on the expectations that the PC market will explode. And it did. But 75% of these companies crashed and burned. There were winners, the Compaqs, the IBMs, but there were lots of losers. And that's what happens with this big market delusion, is there will be a time when investors said that collectively these companies can all succeed. It might take 3 years, 5 years. I call this the bar mitzvah moment, where people say, well, is this sector really grown up enough to deliver profits? That's a big market delusion. So as you watch electric car companies take off in value, as you watch AI companies take off in value, the core story makes sense. The macro story makes sense. The question is, can you sustain all of this? In fact, 3 years ago when I wrote about cannabis stocks, this is when cannabis stocks were taking off, I said, you know what? It's true. I live in San Diego. You know, all you need to do to get high is walk my dog on the sidewalk and I will get high. I mean, smoke coming out of everywhere. I think there's somebody smoking, cannabis in the bushes, in pretty much every bush in San Diego. We know that this is a big market, but that doesn't mean I'm going to attach this high value to every company, because there might not be enough revenues to justify all these companies. Sriram?
What if you think like the market has potential for greater ubiquity than is currently reflected? So like Amazon, for
But
example, you
ultimately,
think
I'm saying
is just
whatever it is about the market, there's a total revenue for that market. You can bring in whatever special, so I'm not saying that's constrained. So you can bring in whatever revenues you want, but I'm saying whatever those revenues are, because people are overconfident, that's the key word, overconfident. Here's what they're doing. They're overestimating their share of those revenues because they're underestimating what everybody else can do. That's basically what's driving this delusion is you think you're the winner. You think you're the chosen company, and every other company thinks the same thing. Collectively, there's a problem. And you know what? I don't think it's a problem we should be solving. I think it's a good problem. And this is why I think when people talk about bubbles, they miss the point. You know why it's a good problem? What do overconfident people do? Even if they crash and burn, they change the way we live. All those dot-com companies in the late 90s that never made it changed the way we live. So when you look at these companies and you feel sorry for the big market delusion, don't. This is the nature of human. I'm sure the guy who came up with fire, the caveman who came up with fire, thought probably too big. But guess what? That is a huge revolution. Every change in human history has come about because overconfident people overreach. So I'm not saying this is a bad thing. I'm just saying it's a feature of big markets. We saw it at the PC market, the dot-com market, the online advertising market, and I'll wager we're going to see it with both artificial intelligence as well as electric cars. It'll play out. I'm not saying every electric car company is overvalued, but I'm saying there'll be 2 or 3 winners and lots of losers. And collectively, what they're estimating can't be delivered. Tim?
Yeah, I have a question about the big market delusion. So let's say a single firm, it's a highly fragmented market, and then a single firm suddenly acquires 50 of its smaller, similar competitors. Does that mean that
the reason that strategy is a loser? Because what does
How-
each company view its value as based on? If you're overconfident, and I come to you and say, how much will you sell the company to me for? You're going to ask me way too much.
Yeah.
That's why roll-up strategies
Yeah.
don't work that well, because you're saying, why doesn't Tesla go out and buy NIO? You know why?
Yeah.
Because NIO is vastly overvalued. If I pay that price, I'm actually paying too much. So roll-up strategies work better in markets where people are sensibly priced, maybe even undervalued. They're underestimating the benefits of being in businesses like AI and electric cars. These companies get to such a high price that paying that price to create a rolled up company just costs you too much. So you know what a better strategy is, right? You basically, as a company, kind of try to essentially create conditions that make it unlikely that your competitors will succeed. You basically run them out of business. You get to the market early, you try to create other benefits. So this is as close to a jungle as you could get in competition, because that's the way you win these big markets. Now, eventually, when you get big enough and they get desperate, that's when you approach them. Right? When they're on their last legs, they need cash to survive. You say, look, I'll pay you 50 cents on what you think you're worth. And then you might roll them up if you think they're worth adding on.
So if they end up rolling up, given all the conditions that you have gave, does that mean it's giving more places for other countries to share the revenue, or it doesn't really have any effect?
It does mean that you end up, but be careful though, because you can buy every electric company, but what is the part that is out of your control? That there are traditional auto companies that are also producing electric. So unless you plan to also buy GM and Ford and Volkswagen and see, this is it, right? Because when everybody sees a market is big, everybody's going after that same market, and it becomes very difficult. So when you look at an Amazon and you look at how it's managed to dominate that is truly an exceptional case. And in fact, when people look at Amazon's history, you say, what did Amazon do that allowed them to do something that very few companies in spaces like this have been able to do?
Thank you.
So let's talk about one final example before we leave this section behind. Now, I value Tesla every year since 2013. If you think about a story stock, this is about as storied a stock as you can get. You know why Tesla is such a fascinating company to value? You're never sure what the story is. In fact, if I asked what's a Tesla story, what's a core story you would say? What's the story for Tesla?
Revolutionizing the automobile industry, and
It's an auto company which revolutionized. You know what? If I asked Rodrigo what the story for Tesla is, he might tell me it's a green energy company. Because it's real. The most revolutionary part of a Tesla car, is the battery. Right? Everything else is nice, but other people can do it. But the battery is what sets Tesla apart, which is in terms of range and in terms of power. There isn't another electric car company that is as advanced as Tesla's. So another person looking at Tesla can also say, you know what, it's not a car company, it's a battery company, which means the end product here might not be that you want to sell every car in the world, but that your battery now is the basis for everything you do, that other people who produce electric cars are going to use your battery. So it could be a battery company, especially since it also owns Solar City, which produces house batteries, right? Basically to heat up your house. And every few months, Elon Musk really rocks the boat by throwing in something else. Hey, you thought that was your story? Let me change the story a little bit. So, maybe it's not an auto company, it's not a battery company, maybe it's a crypto company. This was a problem when you have a CEO like Elon Musk and he says, look, we're going to pay. Do you see what I'm saying? This is a company like this. It's like one of those horror movies you watch with the shape-shifting monster. Elon Musk and Tesla are the ultimate shape-shifting company. That said, though, it's a company that people either love or hate. There's no middle ground with Tesla. And I mentioned this earlier, and I've been one of those people who tries to navigate the middle ground. I get beaten up on both sides for doing it, but I've valued Tesla every year since 2013. In fact, this was a very early valuation I did of Tesla on my blog. I came up with the value like $160 per share, which was actually a very high value for a company which at that time was selling only about 24,000 cars. Think about that, 24,000 cars. To give you some perspective, you know how many cars Volkswagen sells every year? 10 million cars. There are 80 million cars sold every year. They were a tiny automobile company. So I valued at 160. I give them this, upbeat growth, improving margins. And then a couple of days after I put my valuation in my blog, I get an email from an old student of mine. I say, have you seen this equity research report on Tesla? The analyst is valuing the stock at $600 per share. And I said, oh, no, send it to me. He sends it to me. I take a look, and it's first like 250 pages long. A lot of glossy pictures and a lot of stories. And then I keep leafing through, and then I get to page 54 or 55, and there's a D.C.F. That's how the analyst called what he was doing. And I said, okay, this is where I live. Let me take a look at your D.C.F. Because I was curious, why is your value 4 times higher than mine? So I took a first look at revenues. You know what I was expecting to see, right? Much higher revenues than mine because his value was so much higher. And he was actually projecting that the number of cars Tesla would sell would increase from 24,000 to 1.1 million. Let me pause right there. If all I did was told you that, is that a plausible story? Sure, 80 million cars, there are other. So clearly it's an upbeat story, but I said, okay, I can live with that. But it was actually very close to my projection. So I said, maybe he's assuming higher prices for the cars. He was actually assuming about the same revenues that I was and slightly lower margins than I was projecting. And I was completely befuddled. You're projecting about the same revenues, slightly lower margins. So why is your value per share 4 times higher than mine? So I keep going down and see this net income. It's kind of it's a version of, he called his after-tax operating income net income. Don't ask me what he was trying to do. I took his after-tax operating income for the next 15 years. And if you look at the bottom line, it says unlevered free cash flow. That's your free cash flow to the firm for the next 15 years. I added up the income and I added up the free cash flow to the firm. And I compared that cumulated number. You know what the difference is? What is it that separates after-tax operating income from free cash flow to the firm? It's reinvestment. So looking at the difference, I could tell how much he was reinvesting. And I was puzzled because it looked like he was reinvesting close to nothing. Houston, we have a problem. Do you see what the problem is? What is he projecting the number of cars Tesla will sell will do? It go from 24,000 to 1.1 million. In 2013, Tesla had one plant in Fremont with a capacity on a really, really, really good day with 100% capacity of 250,000 cars. Is the hole in the story? He's projecting that they will sell 1.1 million cars, but he's not setting aside the money to build the assembly plants to make these cars. So I called the equity research analyst. I knew of him. I didn't know him, but I knew of him. And he was actually in an airport, I think Newark Airport, catching a flight to go to California. I think he was going to worship at a Tesla shrine or something. I wasn't sure what he was going to do. And I said, look, I've been looking at your equity research report, and I was looking at the D.C.F. I wanted to use the same terminology. I didn't want to confuse him too much. And I said, I have some questions. And he said, I cannot answer those questions. I said, why not? He said, well, I don't really work with the numbers. I have a team that does the numbers. I said, you have a team? He said, a team of 6, very proudly. I said, okay, can I call you when your team's around? And he said, yeah, a week from now, I'll be back. My team will be around. You can call me then. And I said, okay. And he said, you're not going to write about this on your blog or anything, right? And I said, not for the next week. And then all bets are off. So I call a week later. The analyst is with his team, and he answers the phone, and then he goes through, and then I asked, what do you do? And he said, no, I schmooze. I said, what? He said, I schmooze. I talk with management, I talk with experts, I talk with other analysts. I said, okay, I mean, somebody needs to schmooze. What about your second in command? This guy comes on and he says, well, I too schmooze. I go with this guy when he schmoozes, I'm filling in gaps in the conversation. I'm schmoozing too. I said, okay, what about third in command? He says, well, I'm the backup schmoozer. One of these guys can't go. I step in and schmooze instead. I said, who in this group does anything but schmooze? They point to this young, this 23-year-old that hired out of Wharton the previous year. They say, he's the guy. He does all the numbers. I feel really sorry for this kid. So he comes on, and he's a smart kid. He's done. So he's got the. He's looked at them. He's familiar with the mechanics. I take him through line item by line item, and he very quickly gets it. Gets what? The fact that he forgot to set aside money to build assembly plants. So I said, what happened? He said, slipped my mind. I said, what slipped your mind? He said, I have to set aside money for assembly plants. And he said, I just took last year's numbers and I just projected each one. You know how we do financial modeling. And last year didn't have much in CapEx, so it just completely slipped my mind. I said, do you think you have a problem? He said, obviously, you can't make 1.1 million cars with this Fremont plant. But we can't go to the market and tell them that it slipped our minds to build assembly plants. Do you have a suggestion? I said, yes, but you might not like it. I said, have you ever seen this movie, Willy Wonka's Chocolate Factory? He said, no. I said, and another guy said, yes, but he'd seen the Johnny Depp version, which is really not the real Willy Wonka's Chocolate Factory. But one of the older analysts said, yes, I've seen the movie with Gene Wilder. One of my favorite movies, but I still remember coming out of that movie with a big question. That movie, there are Willy Wonka chocolates in every store in the world. And there's one factory, a very inefficiently laid out factory with like chocolate rivers running through it and strange looking creatures wandering around. And I always wondered, how the heck do they produce all these chocolates in this one factory? And the answer is actually in the movie. These magical creatures called Oompa Loompas. If you get a chance, go on Google search, type in the word Oompa Loompa, and you'll find them. And they dance around the factory, and as they dance, chocolates come flying out of the windows. It's magic. I said, here's what you need to do. Put out a press release that Tesla has fired all their Fremont workers and replaced them with Oompa Loompas. That'll take care of your problem. Oompa Loompas can produce as many cars as they want. I call these Oompa Loompa valuations, and I see an awful lot of them coming out of equity research reports. Valuations, they have high growth. I have no problem with that story, but nothing is set aside to cover that growth. So when you tell a story, be your own toughest critic. Ask those questions. Dot your I's, cross your T's, because you want to make sure you're telling a story that makes internal sense. So now I've told my story for Uber. I've tested the story. I'm ready to go. Next step in the story, I've got to convert every part of my story to a number. Do you remember what my original story was? I described Uber as an urban car service company, right? which will attract new users into the business, have local networking benefits, and continue to do what they're doing right now, which is not own the cars, not hire the drivers. You're going to see this now play out as inputs. I describe them as an urban car service company. So the total market I'm going after is the urban car service market. And in 2013, you know what that market looked like? Before ride-sharing companies became big, if you were taking car service pretty much anywhere in the world, only two things you could use, right? A yellow cab or a taxi cab approved by the city, or a limo, one of these car services that offered like hundreds of cars. You know, investment bank, you'd see them at 9 o'clock at night, these cars would pull up, you know. And that business was entirely privately run, small companies in different cities. Getting the size of the urban car service market was one of the most tedious things I've ever done in my life. There was no source that gave me that. I tried Google search, found nothing. See now how I got the size of this market? I went city by city, and it turns out that taxi and limousine regulators in each city have measures of how much taxi cabs made as revenue. So I went to New York, San Francisco, so I went along. And there were some cities where I didn't have the numbers, so I used the population to extrapolate. And when I was done, I came up with $100 billion size for the car service market. To show you why you shouldn't trust Google search. Remember I said when I tried Google search, I found nothing. So 6 months later, I say, okay, there must be a better number by now. Let me try Google search again. I try Google search, and the number one finding that comes out says that the urban car service market is 100 billion. I say, this is amazing. This guy's the same number that I do. So I hit the click, and it takes me to my website. And I'll tell you, look, I know exactly how shaky that number is. So when you see something on Google search, be very careful, right? Because it basically reflects somebody's number. It becomes part of the public domain. Next thing you know, it becomes conventional wisdom. So urban car service company. And remember the second part of my story? That it'll attract new users, people like my son and my niece, young people. So I said, okay, I'm going to find those people. And the way they're going to show up is as a higher growth rate. So the way I showed this in my numbers is that $100 billion urban car service market had been growing at about 1 to 2% a year for the previous 5 years. I let it grow at 6%. That extra 4% are people like my son and niece, 20, 25-year-olds who say, look, I'd never take a taxi cab, but I'll take car service. So second part of my story is in there. Third, remember I said Uber has local networking benefits. If you get past the storytelling, what does that mean? Well, Uber can take New York, Lyft can take Chicago, Didi can. So basically in my story, you can have 8 or 9 or 10 different ride-sharing companies taking different parts of the world. The way this played out is when I gave Uber a market share, I gave them a 10% market share, huge by car service standards, but I stopped at 10. Why? Because there were 9 different players in different parts of the world. Nobody's going to take 40 or 50%. And then I looked at their business model, which is, what do? They connect drivers to customers. They're an intermediary. You know what intermediary profit margins look like? They're sky high. Look at booking.com. Look at any online advertising company. You're connecting people. The margins I gave them reflected the fact that they keep 20% of fare, a 40% margin. Basically, they kept most of that 20% because there are very few costs. And then finally, I had to look at reinvestment. For Uber to grow into a new city, what does it have to do? It doesn't have to buy cars and put them on the ground. It just has to get a bunch of people who are willing to drive for it and say, okay, come drive for us. So it can grow with very little reinvestment. It's a low capital intensity business. And the way this showed up is I gave them a sales to capital ratio of 5. You're saying, how do I know whether it's high or low? Take a look. I report this by sector. The average across all US companies is about 2. You get $2 of revenues per dollar of capital invested. If you're in a capital intensive business, it's actually less than 1. Infrastructure companies often have sales to capital of 0.7 or 0.8. If you're a software company, it could be as high as 2.5 or 3. I've given them $5 of revenues for every dollar of capital invested. Every part of my story is now a number, right? Now, I got to this point, and then I remembered that to do a DCF, I need a D. How many sessions did we spend on discount rates? Betas, risk-free rates, risk premiums, currencies. I'm going to ignore all of my own lessons and spend about 3 minutes getting the cost of cab for Uber. You know why I'm going to ignore all the lessons? Because what the heck am I going to do with betas and risk-free rates and risk premiums? This is a risky company. Do we all agree in 2013 Uber? It's a young, risky company. I want to give them the cost of capital of a risky company. So here's how I did it. Every year, at the start of every year, including this one, I put up a histogram of cost of capital of every publicly traded company. You know what a histogram is? I'll give you the 10 percentile, the 20. So I take 46,000 companies and compute the cost of capital for every one of them. This year's median is about 5.3%. The 90th percentile this year is about 9 to 10%. A risky company right now in dollar terms is a 9 to 10% cost of capital. In 2013, the 90th percentile was about 12%. I use that as my cost of capital. It's a company that's still evolving. I give it a high cost of capital. And it's still a company that has a chance it won't make it. It's still a young money-losing company. So I said there's a 10% chance a company will not make it. And if it doesn't make it and it liquidates, I'm going to get absolutely nothing. Why? There are no assets, right? What am I selling? I mean, I'm just an intermediary company. I'm ready. I've taken my story, converted numbers. The valuation kind of does itself. This looks like a valuation spreadsheet. In fact, I use the same spreadsheet you guys have, but the numbers are coming from my story. So if you pointed to a number in this valuation and say, why is this number what it is? I'm going to respond with a story. Let's try. If you ask me, why are my revenues 3.6 billion? You know what my answer is going to be? Because they're an urban car service company with local networking benefits. If I ask you, why are the margins so high? Is because they keep 20% of the fare for doing nothing. Why is the reinvestment so low? Because they don't own the cars and they don't hire the drivers. Why is my cost of capital so high? It's because they're a risky company. Every number I back with a story. But with my numbers, the value that I got for Uber on June 8th of 2014 was about $6 million. I actually remember, so Friday I posted this, I think at 3:15 in the afternoon on my blog. At 3:30, I get a call from a Wall Street Journal reporter. I don't know what she was doing. Maybe she was sitting at her desk waiting for this to come through. And she said, I noticed you just valued Uber. And I said, yes. And thank you for noticing. She said, I noticed you put a $6 billion value. I said, you're very observant. Then she said, you do know that venture capitalists have valued the company at 17 billion. I almost corrected her there. Jake, you know what I was going to correct her with, right? So when she said venture capitalists have valued the company at 17 billion, what do you think I was going to come back with? I bit my tongue. I didn't come back with it.
Maybe you say like they priced it instead of valued
They
it.
priced it. Venture capitalists don't value companies. What do they price it on? Users, subscribers? No. Why? Because they're in a pricing business. You don't make money as a venture capitalist by valuing companies. You price it and you flip it at a higher price. But I let her go. She's a journalist. I cut her some slack. I said, okay, I do know that venture capitalists have valued the company at 17 billion. And she said, how do you explain that value? I said, I don't have to. I didn't pay it. And she said, are you telling me they're wrong? And I said, no, nothing of the sort. I'm saying with my story, I can't get to 17 billion. Maybe they have a much bigger story for Uber. Maybe you should talk to them and see what their story is. What I'm trying to say is when you value a company, it is your story and your valuation. It's not the story and the valuation. When I value a company, it's my story and my valuation. You know why? Because it's my money that's being invested on this. It has to be my story and my valuation. So that is step 4. The valuation kind of does itself. And you remember what step 5 is? After you're done with the valuation, what did I suggest you do? Seek out people who don't think like you. Get their feedback on what they think about your valuation. And rather than get defensive, listen, see if you can make your story better. And I got incredibly lucky because This post came out on June 8th of 2014. The next week or two, it got picked up in 4 very different places. The first was a site called 538.com. You guys familiar with 538? It's actually a site maintained by Nate Silver. He's a statistics math geek. It's a fun site if you like numbers. So the editor of the site said, can we run your post and the valuation intact? We won't change a word. And I said, go ahead. The second place it got picked up was the Forbes blog. You know who reads the Forbes blog? 75-year-olds with flip phones, I think. It's a very old-time value investing audience. The third place it got picked up is a site called TechCrunch. You know who reads TechCrunch, right? Geeks. VC geeks, tech geeks. It's Silicon Valley's, digital magazine. And the fourth place it got picked up was this fun site called the Ride Sharing Guide. If you get a chance, go on Google and find the site. It's still around. It's maintained by a guy called Harry Campbell. It's actually a site for Uber drivers and Lyft drivers. There are millions of them. Same post, same valuation, 4 different places. And I got 4 very different sets of response. On the 538.com site, here's the kind of question I get. I just looked at your valuation of Uber and I noticed that you used a 12% cost of capital and you said that it came from looking at your histogram. I'm looking at your histogram and the 90th percentile, which is what you said you used, your cost of capital is 11.97%. How come you're using 12%? And my response is, take the damn Excel spreadsheet, replace 12 with 11.97%, see what happens. And 5 minutes later, I get an email back saying nothing happened, sorry. So nothing it's all, the 538 side, everything was about second decimal point. There's nothing of value that I learned. On the Forbes blog, they loved what I did. They said, you know what, this is how VCs and founders should think. I didn't even waste my time on that side. They were too busy patting me on the back. On TechCrunch, they absolutely hated what I did. Their response was, how dare you value one of ours with your D.C.F models? We don't do that in Silicon Valley. And there was a torrent of abuse. Some of it was just pure abuse. I remember things like, you DCF guy. That's the entire comment. What does that mean? Good, bad? One even said, you New Yorker, end of comment. Supposedly, I guess this is an insult. That's all I'm supposed to get out of it. No. But if you went past the pure insults, there were comments that started with, you idiot. Let me tell you how ride sharing works. Let me tell you how Uber sets surge pricing. Remember, I'm not a tech guy. I don't know much about how the ride sharing business is structured. I learned a great deal about the technology of ride sharing by reading past the insult. And then I went to the ride sharing guide and I learned some very interesting things about the company. Things I would never have learned if I went and talked to Uber's top management. There was an Uber driver from LA. He wrote to me and said, look, I looked at your valuation. I don't know much about valuation, but I noticed you assume that Uber keeps 20% of the fare. And that's what they tell their investors, but that's not true, he said. He said, here's what's happening in LA. I used to drive for Lyft until 2 months ago. Uber paid me $2,500 to switch away from Lyft. Lyft is now offering me $3,000 to switch back. And I feel like a free agent without a contract and keep playing these guys off. He said, I wouldn't be surprised if after all of this is said and done, if Uber kept more than 7 or 8%. They're not keeping 20%. You know what? 4 years later, Uber made an admission. They said, we've been telling you guys, investors, that we keep 20%, but in our biggest cities, our contribution margin, which is what we're left over, is closer to 7 to 8% of the fare. I almost responded then by saying, hey, I knew this already 4 years ago from talking to an Uber driver in LA. Don't underestimate what you can learn about a company by talking to people in the trenches. In 40 years of valuation, I've never once, not once, valued a company after talking to its top management. I've never talked to a CEO, I've not talked to a man. Because to me, this is one of the biggest wastes of time, is sitting there and you listen to a CEO paint this PR story about a company. I'd much rather be in the mailroom of that company, figuring out who's actually showing up at work and whose mail is building up. That might tell me a lot more about the company. But with Uber, actually, this all came to fruition. About 2 weeks after I wrote my post, I was in Munich airport waiting for a connecting flight, and my flight was delayed. So I was checking my email. And I noticed an email from a guy called Bill Gurley. For those of you not familiar with Bill Gurley, Bill is a partner at Benchmark Capital, one of the leading VC firms. Benchmark Capital was one of the first venture capitalists to invest in Uber. They invested $1 billion pricing. Bill Gurley was on the board of directors of Uber in 2013, and he was rumored to be the person closest to Travis Kalanick. Those of you who don't know Travis was the CEO of Uber. So let me ask you a very simple question. Does Bill Gurley know more about Uber than I do? Absolutely. So I see this email, I open it up, and here's how it begins. I read your post on Uber. He's talking about my blog post, and he said, I read your post on Uber and I did not like it. Okay, we got that out of the way. He said, I've written my own blog post to counter your blog post. It's blog post to blog post warfare, very high tech. And he said, I've said some mean things about you. I just wanted to let you know. Sincerely, Bill. I closed the email. I still have an hour left for my flight. Guess where I go next? I go to Bill's blog. I want to see what mean things he said about me. It's called Above the Crowd. He's 6'6", so Above the Crowd kind of makes sense. And I start reading, and it takes issue with every part of my story. He says, Uber is not a car service company. It's a logistics company. Notice how words have consequences. By using the word logistics, what's he just done? Uber could be in car service, Uber could be in delivery, Uber could be in moving, Uber could be in freight. They're all logistics businesses. He said, Uber is not just an urban company. It can be suburban, it can be rural. He gave examples. And then he added the cherry on the top. He said, in your story, you assume that Uber dominates New York. You're stuck in New York, but we're getting partnerships with the airlines and with credit card companies, where if we end up dominating New York, we're going to find a way to transfer that dominance into other cities. Like what? He gave the example of partnering with United. And you're flying from New York to Jakarta. You make the reservation in United, and right after you make the reservation, there'll be a box that says, do you want an Uber car waiting for you when you land? If you click the box, the Uber car will be arranged. And his argument was, look, if you're flying from New York to Jakarta, you don't want to go to Jakarta, load some local GoCheck app. You're going to use Uber. It's already. I was fascinated. I finished the story. I have 50 minutes left for my flight. I email Bill back and I say, fascinating. Along the way, he gave multiple swipes at me, but most of them cares. My skin is thick enough, I can take those. So after I read the story, I emailed Bill and said, would you like me to put a number on your story? And he says, what are you talking about? I said, you've told a really big story about Uber. I can make it into a number. He said, be my guest. So here's what I did. I went to my valuation of Uber. Remember that I've given them $100 billion total market? I tripled that. Why? Because that's what the logistics business brings. And you bring in moving and delivery, you're looking at a much bigger market. Remember that 10% market share I gave them with my local networking story? If Bill's right and this becomes a global networking story, there wouldn't be 9 ride-sharing companies around the world. There might be 3 or 4, which means Uber's market share can be as high as 40%. You give them a $300 billion total market and a 40% market share. The value that you get is $53 billion. I'm still sitting in Munich airport. I emailed the spreadsheet to Bill and I said, do you like this more? He said, a lot. And then he said, you know what, that 20% slice of the fare, I think that's going to go away. I think we're going to end up with about 10%. I almost told Bill, I know this already. I talked to the Uber driver in LA. But I said, that's easy to fix in my spreadsheet. This is an input. I'll take the 20% and make it 10. The value that I get for Uber is $29 billion. He said, how can the same company be worth $6 billion, $29 billion, and $53 billion? Depends on how you frame your story. In fact, to kind of emphasize this point, in December of 2014, I did something that I do fairly frequently with companies where there's a lot of disagreement about the future. And over the 6 months between June and December, I kept hearing from people saying, I don't like your story. I don't like this. And I got tired and said, look, you don't like my story. Why don't you tell your own story and I'll help you? So what I did was created a post where I let people tell me what the story for Uber was. So the first step, I said, look, tell me what kind of business Uber is in. Is it a car service company, a transportation company, a logistics company, or is it an on-demand company? You know what an on-demand company is? It's a company that basically does you need something in a hurry, they can do it for you. And I think the closest thing I've ever seen to an on-demand company is this Indonesian company called Gojek. Do any of you ever heard of Gojek? Gojek is this Indonesian company where it's like Uber in some ways. You know, the only difference is they're motorcycles. It's kind of scary, but you know why motorcycles work better, right? If you've ever been in Jakarta traffic, nothing moves. So you call a Gojek, a guy in a motorcycle shop, luckily comes with an extra helmet. You put the helmet on, you jump on the back of the motorcycle. So it's like Uber in that way. But that's not all. Let's say you live in Jakarta, you come home from a long day at work, you forgot to pick up your pills, your allergy pills at the pharmacy. Gojek will pick it up for you and deliver it to you for a fee. Let's say the new Avengers movie comes out, and these were the days when it came out in the theater, but you have to stand 3 hours in line to get your tickets and you don't have the time. A Gojek will put somebody in the line for you, wait 3 hours and get the ticket for you. So basically, whatever you need to do, they will use somebody to do it for you. So I said, so what kind of company do you think Uber is going to be? Then I said, what kind of networking benefits do you think we'll have? Global, local, none. What kind of competitive advantages do you see it having? Strong, semi-strong, weak, no competitive advantages. And as people picked the story, I basically kind of created this spreadsheet where as you picked your story, it kind of came up with the value reflecting your story. If you look at the last column, you can see based on the story that Uber's value can be less than $1 billion or more than 90 billion, depending on how you frame the story. Now, when I posted this, people said, this is why you shouldn't do DCM, because you can get any number you want. That's not how I see this table. What it means is you can have disagreements on value, but that doesn't mean the other person's wrong and you're right. It just means you have different stories. One of your stories is clearly more plausible than the others, and that's what this debate should be about. I mean, I find too much of valuation discussion built around right and wrong, which is you're wrong, I'm right, and it doesn't work for me. We're all wrong. Let's start with that presumption. The question is, who's less wrong? How do we make that mistake smaller? And that's what stories do. Which brings me to my final point, which is once your story is told, don't just sit on it, because your stories can change. And you can see they can change because new information comes out, macroeconomic developments. I'll give you a couple of examples, 3 ways in which your story can be affected. Your story can break. What causes your story to break? You're having a young pharmaceutical company with this blockbuster drug working its way through the pipeline, but it's in stage 3 of the approval process. You know what the story that could break your company is? A story that comes out that 2 people are in that final stage 3 test have developed serious symptoms and maybe died. That's it, right? The company's done. The FDA will make you pull that drug off. What you thought was a multi-billion-dollar company could be worth nothing. That's a story break. Your story could stay the same, but the contours can shift. I've told the same story about Apple now for about 10 years, the greatest cash machine in history that derives the bulk of its value from a single product. What's a single product that drives Apple more than any other? The iPhone. 75% of Apple's value comes from the iPhone. It's a smartphone company with a lot of neat stuff on the side. I've told that story, but that story's contours have shifted. Why do they shift? Each time an iPhone comes out, I've got to reassess the potential market, the potential margins. And finally, your story can change. And my favorite example for this is what's happened to Peloton over the last 3 years. In September of 2019, when I valued Peloton, I valued it as a company that produced really expensive fitness equipment. You know what a Peloton bike costs, right? $2,500. A Peloton treadmill costs $4,000. You're paying well above what you pay for Nordic Track or Life Fitness. And September of 2019, when you bought this bike, what else did you usually buy with it? Otherwise, it's a very expensive. You bought a subscription. And the subscription cost $40 a month. I still remember watching CNBC, and this equity research analyst comes on talking about Peloton. And he says, you know what, there's this subscription, I think everybody's going to get it. And I'm sitting there, saying, really? He says, everybody in my building has a Peloton app. My reaction is, you need to get out of your damn building and walk a few blocks away. Because how many people in any part of this in the world can afford to pay $40 a month for a fitness app? I mean, you pay $15 a month for Netflix, you pay $40 for, but that was in September. They were a luxury fitness company going after a niche market. You're saying, what changed? COVID came along. Okay. And what did COVID do? It opened up a new business for Peloton, which is Peloton has this lower cost subscription, $13 a month, where you can use it on your regular exercise bike, your regular treadmill, and it's exploded. I think when I value Peloton today, I value it as a subscription company that sells some fitness equipment on the side, because that's where the future of Peloton lies. The story changed because the world changed around it. But one of the things I ask people to do with COVID is take your company and ask, how has COVID affected my company's story? Who's valuing Carnival Cruise Lines? Somebody's valuing Carnival Cruise Lines in this class. You don't want to admit? Take Carnival Cruise Lines. Do you think its story has been changed by COVID? Jake, what do you think?
Yeah, I think so, because less people will be
Even
traveling.
if COVID goes away, why is your story different?
Maybe they'll like put less people on boats, so
There
more
is
revenue.
zero chance I will ever step on a cruise ship for the rest of my life. Because what do we learn? Cruise ships are like petri dishes, right? Whatever disease you have, I mean, you're stuck in the high seas, you have 500 other people, or, you know what? There are people who will continue to go on cruises. But your potential market just got a lot smaller, even if COVID passes. Which means if I value Carnival Cruise Lines now, the value I'm going to get is going to be significantly lower than the value 2 years ago. You could say the same thing about airlines. Right? The business has changed. There might be much less business traveling even after COVID is done, because we've learned we can run Zoom meetings. It costs a lot less. So what you're looking at in your company is, how has my story changed? Because the story you're telling is a forward-looking story reflecting where you are now. So now let's actually value companies. Notice we're 14 sessions into the class, and I haven't valued a single company yet, right? I've valued pieces of companies. I've done revenue growth, the margins for every, but I've never, and it's about time we actually value companies. Tim, you have a question?
Yeah, the Carnival Cruise Line, didn't they just I don't know when, but like they issued the equity, and then
you know why they had to issue equity? Because they need to survive.
But
right?
then
they're in serious trouble. They have to issue equity to survive, because the way they usually fund these cruise ships is with debt. And because the cruise ships are not traveling, if they don't raise equity, they're going to go bankrupt.
Yeah, but that part of the financial engineering of raising capital really doesn't really play a role in the story.
Survival. It improves their chance of survival. If they hadn't done that, remember that failure probability that I attached? Carnival Cruise Lines, when I valued them in the middle of last year, I was attaching a 50% chance that they would not make it. Now with the equity issue, I'm willing to reduce that amount, but it's not because you're a more lucrative business model, but because you've improved your chances of survival.
Okay, thank you.
So what you're going to see for the remaining 12 minutes of this class and spilling into the next two classes is valuation after valuation, right? I'm going to value about 20 companies, difficult to easy. But I'm going to do two things. One is you're going to see an equity risk premium pop up. It's going to be different. Some of these valuations range from, I think my earliest valuation you're going to see is from 1999. And my latest valuation is going to be 2021. You're going to see different equity risk premiums in each one. And I'm going to preempt how I'm going to tell you how I get these equity risk premiums up in advance. I'm not repeating myself in valuation after valuation. Pre-1998, there might be one valuation. I used to use 5.5%. Why? Because I used historical risk premiums. That's the way I was taught, and I stayed with that. That's when I moved away, 1998. So starting in 98, I moved to implied premiums. And between 98 and 2008, the implied premium in the US was roughly 4%. That's what you're going to see as my equity risk premiums during that period. Then you had the crisis. The valuations you're going to see in 2008, towards the end of 2008-9, you're going to see 6% premiums. Why? Because the world got riskier. And starting in 2009, I've become almost entirely equity risk premium, the implied premium driven, because my valuations reflect when I do it. And with each valuation I'm going to show you, I'm going to tell you my story for the company first. I'm going to try to stay true to that. And then you're going to see my valuation. And with each valuation, I'm going to focus on a part of the valuation that I think makes it different. Rather than go through every part of you're going to get tired of me going through free cash flow and cost of capital for every company if I'm doing the same thing. I'm going to focus on what I'm doing differently. So let's start easy. Now, when you first learn to bike, you bike with training wheels, right? Because that way you can't fall over. Let's put training wheels on. Let's start with the easy company valuations. And the first company I'm going to value is perhaps the simplest of all valuations. It's a regulated utility. For those of you not familiar with how regulated utilities work in the US, usually you're a monopoly. You're a power company, you're a water company, you're given a monopoly. And normally when you get a monopoly, you get very excited, right? What's the power that monopolies have? They can set whatever price they want. It's a monopoly, but with a regulated utility, you don't have pricing power. So when Con Ed, which is the regulated utility that supplies power for New York, wants to set prices for power, they have to go in front of a regulatory commission that tells them how much they can raise prices. So basically, these are stable companies because they provide a non-discretionary product, power or water. They can't grow revenues very much because their pricing is restricted and the demand for electricity is not growing either. It's a mature demand. This is a stable company. So one of the things I wanted to do is check to see whether I could use a stable growth model to value Con Ed. And I checked three things. First is I checked to see whether they were paying dividends like a mature company. What do mature companies do? They pay a high percentage of their earnings as dividends. And you know what? Con Ed fit the bill. They were paying 73% of their earnings as dividends. Second, I checked to see whether the growth rate they had was a growth rate that was compatible with the mature company. Remember, mature companies grow at a rate less than or equal to the growth rate of the economy. And if I take the retention ratio and return on equity, remember that fundamental growth? The growth rate I get for Con Ed is 2.1%, which is actually lower than the risk-free rate by a lot. So this is a company that's clearly a mature company. And third, I looked at their risk and cost of equity. Because remember, mature companies should have a risk close to the market and a low cost of equity. And it fit that bill as well. So they have a beta of 0.8 and a cost of equity of 7.7%. My life just got very easy. To value the company, here's what I did. I used a stable growth dividend discount model. It's called the Gordon Growth model, the oldest discounted cash flow model around. I took expected dividends next year. 232 is last 12 months dividends. I grew it at 2.1%, expected dividends next year, divided by the difference between the cost of equity and the growth rate. What I get as a value per share is 42.30. That's it, I'm done. You're saying, I wish I'd picked Con Ed. You can still pick Con Ed if you want for your company. Your valuation will be done in like 2 minutes, but you're not going to learn a whole lot. The stock was actually trading at 40.76. So it looks undervalued, right? But not by much. It's like within 3%. So one of the questions I asked was, hey, this rests on this 2.1% growth rate. Could I be wrong on that? And the answer is, of course. So what I did was I kept everything else constant in this valuation, changed as the growth rate to see what growth rate would give me a value roughly equal to the price. You see what I'm trying to do here? I'm trying to see how I get to the market price. What is the market assuming? I was assuming a 2.1% growth rate. The market was assuming a 2.07% growth rate. You see what that also means? I'm not going to go out and do something crazy on this valuation. This is like a second decimal point. If I'm off by 0.03%, everything goes away. When you value a company, here's a recommendation I'd make. Do your traditional DCF valuation. You're going to come up with a value that's different from the price. Save that. That will be a base case valuation. But then go back to your valuation and change your revenue growth rate. As your revenue growth rate changes, check to see what break-even revenue growth rate you will need to get the price you see per share. Change the margins. Change both. Check to see what the market is assuming, because that will then give you a sense of how much buffer you have in your valuation when you go out and buy the stock. So the value I got for Con Ed was $42.30. The cost of equity was 7.7%. And I expect the company to pay about $2.37 in dividends next year. Parker, can you help me out here? If I ask you assume my value is right, and I ask you, what will the price per share be a year from now? Would you be able to give me that number? What's the essence of a fair value? That you're going to earn at least your cost of equity, right? Basically, you're going to earn your cost of equity. Cost of equity here is 7.7%. So if I invest at 42.30, over the next year, I should make a 7.7% return. Everybody agree? That's what fair value is. That return can be made in one of two ways: price appreciation and dividends. I've told you what the dividend portion of this is. The target price a year from now will be 42.30, grown out at 7.7%, minus the dividends you will receive, because that dividend doesn't become part of your price appreciation. Try it out. And then take it to the next step. I ask you, what will the target price be 5 years from now? What are you going to do? You're going to take that price appreciation and you're going to keep compounding, and you can give me a price 2 years from now, 3 years from now, 4 years from now, 5 years from now, built on your DCF valuation. And if you go buy the stock today at 40.76, your return next year will be well above 7.7% if your valuation is right. You're going to earn 11 or 12%. That is what an undervalued stock delivers to you. I know we're getting to the end of the class, but let me close the class with a couple of valuations. Company that, and these were valuations around a crisis. The first, this valuation of 3M. You know what 3M does, right? Boring stuff on which it makes huge margins. Things like the Post-it note. You know how much money the Post-it note has made for 3M over its lifetime? Billions of dollars. And it's the kind of product you look at and say, I could have thought about that. You feel like whacking your head. So why didn't I think of that first? Stick them and put some sticky stuff in the back of a yellow thing and stick it on the wall. It's a mature company. It's a money-making company. And September 12th of 2008, that was the day before the 2008 crisis started, I valued the company. And the story I told about this company was it will continue to earn high margins because of its brand name and earn a high return on capital. In fact, a 25% return on capital. And it's a pretty conservatively run company, so it's not going to go do anything crazy. You know, it's not going to go to Asia or Latin America and try to do crazy things. And in 2008, I gave them a 30% reinvestment rate. So I'm telling a story of a well-run conservative company that's going to grow at about 7.5% a year before settling to stable growth. In fact, after the 5th year, I assume the competitive advantage will disappear. If I discount those cash flows back at the cost of equity before the crisis, 7.88%, the value per share that I got was $83.55. So this I did, I think, midday on September 12th. Stock was 70. Now, I wanted to buy the shares. And I'll make a confession. I didn't have some huge insight that led me to delay it. I just procrastinated. I said, do it on Monday. I'm just feeling lazy now. And of course, I'm glad I waited till Monday, because over the weekend, the markets melted down. The crisis started. So the stock looked undervalued on September 12th. I revalued it again about a month later. And I'll tell you something, none of the numbers for the company changed. There were no earnings reports that had come out. The same company, same numbers. But my value is $60.53. You see, what happened? 2008 crisis happened. Here's how it played out. Remember the cost of capital I had was 7.88%? It jumps to 10.27%. You know why it jumped to 10.27%? Because the default spreads and the equity risk premiums I used became much bigger. Remember we talked about how they change during a crisis. my discount rates went up. I also got more pessimistic about the future. Why? Because the economy was clearly going to be affected by this crisis. We're going into recession. I gave them a lower return on capital and a lower growth rate. My $84 went to 60. You know, last year in the spring, when people were taking this class, the project was due towards the end of March of 2020. There were people who started their valuations in January. And then, of course, the market melted down, right? 30% drop. The equity risk premium shot from 4.7 to 7.8%. You got to live in the world you're in. And I'm reflecting the risk I faced, lower value. But before you get too excited about this, look at what happened to the stock price. It dropped to 57. In fact, it continued to go down. I ended up buying 3M in November when it dropped to $45. It's still in my portfolio. It's one of those rib rock investments you just leave in there. But my point is, just because you're in a crisis doesn't mean, and even if you get no information, you have to revisit your valuations. So pray and hope that between now and May 10th, we don't get a full-fledged crisis. Because you know what that'll mean, right? You got to revisit your DCF and change numbers like your equity risk premium to reflect where you are at that point in time. So I'm going to leave you with that thought, because when we come back on Monday, I'm going to take you to the valuation of the S&P 500 in November of 2020 with the update from January 1st of 2021. And we're going to talk about valuing difficult to value companies. So that's about it. And I'll talk to you soon.
Okay, Professor, can I ask
Thank
you
you.
a question?
Sure.
Yeah.
Nick, go ahead.
Yeah. So basically,
Thank you, Professor.
like I'm valuing you. I don't know if you saw on the spreadsheet, but so like I was considering maybe changing it because like I really focused on developing the story before the numbers, you know, and I researched the industry, like competitors and stuff. But like when like I've told you I have dyslexia. When I think about like projecting these the null, you know, like I get crazy, like to think of like seeing if
Hey,
all those
why don't you
numbers
do
are
this?
right.
Pick an easier company for the project. Value Neo on the side.
Okay, I see.
Right? That way you don't get this stressed out about, am I getting this right? So if you want to take Volkswagen or one of the established companies in the space and you want to make that your project company, this way you're not stressed out. Or what do I do if my story comes apart? But I would strongly recommend that you still value, given the work that you've done, that you value it as a separate company. It's not for your project, it's just for your life. Because you will learn more about valuation by getting uncomfortable and learning to get comfortable again with uncertainty.
I see. Thank you, Professor. That makes sense.
Yeah. Effie?
Yes, Professor. Hi. So I was going to ask a project-specific question. You talked about preparing a base case scenario, also checking for break-even growth rates and margins. My question would be about that base case scenario. So I'm valuing Fiverr, which is an online platform for, I was wondering what would that base case scenario would look like in the
you're
case of
putting your
high growth
investment behind. So your base case scenario is what you think is the expected scenario for the company. That's what base case means. It's not a conservative scenario. It's not what the management projects. It's what you think is the best. So remember all those paths that Uber can take? When I sit down to value Uber, I have to pick the path that I think is closest to where I think Uber will go. That was my $6 billion value. My investment decision is driven by it. Now, of course, the actual scenarios, you could say, could be very different from that, but that is what a base case scenario is. And then once you get that base case nailed on, that's what your investment decision is based on. You can ask, what if my growth were higher? And that's giving you more comfort than with your base case saying, if I were to decide based on the base case, what are the parameters that are driving that value?
So how do I get the expected scenario then? Do I read reports to get that?
If it were that easy, you wouldn't need people, right? So in the case of Uber, I could have read the reports, but after all of the reports are read and done, you still have to make your own judgments. Right? So you can start by reading the reports, whatever you want, but don't get too caught up in looking for the answer in one of those reports, because those reports give you raw material to tell your story. But the story ultimately has to be your story.
Thank you, Professor.
Tim?
Yeah, I have two questions. One is if I am trying to value a SPV that only holds a one project that costs about $60 million, do you think, and it's a midstream
Is it a
oil hub project?
finite life project?
It's could that I don't know. It's like an oil hub midstream project.
Then it's
and-
finite. By definition, oil hubs have to be finite because once your oil's out of the ground, you're done. It's valued like a capital budgeting project. It's to do cash flows, but here's what you will not do. You will not stop in your 5 or 10 in estimated terminal value. You'll actually project out cash flows over so let's say there's 30 years of oil in the ground. You project out cash flows for 30 years. You'll discount the cash flows back to today. It'll be closer to what I did for Aramco. Aramco is the biggest and most lucrative oil hub in the world, right? It's 300 million barrels. If you look at my Aramco valuation, there is no terminal value. It's just 50 years of cash flows.
Yeah.
No.
So that's right.
What I would do.
Like I will project the cash flow until there's zero terminal value.
Right.
But then that's too difficult to do, right? Like, well, I don't know. I'll look into it.
Do you know how much there are in the reserves? Presumably, if you're investing in this, they've told you how much they have in reserves. How many barrels of oil are there?
The capacity is 130 million barrels, so it's pretty big.
That's the reserves or the capacity that they have each year. So reserves are 130 million. So that must be the reserves. What's their capacity per year? How many barrels of oil are they producing per year?
They're not producing anything. They're just stockpiling.
But what do they plan to? I mean, clearly, when you have that reserves that big, you must be expecting to produce what, 5 million, 6 million barrels a year. So what you look for is that production, because that's what they're investing for, because that's constrained by the number of rigs you put in and the capacity you built for converting the oil from, the oil that comes out of the ground to oil you can sell. So look at what they've invested, get a sense of the capacity. Let's for purpose of argument, let's say they can produce 10 million barrels a year. That's probably excessive. Let's make it 5 because 10 is going to be too much. You could disturb the entire oil market. 5 million barrels, 130 million potential reserves. That's 26 years, right?
Yeah.
So basically you'll have 26 years of 5 million barrels of oil a year. Don't play games with the oil price. Just take, today's oil price with the inflation built in. So you've expected oil prices, get revenues, costs, cash flows. It'll actually be a very straightforward valuation.
Yeah.
There's not a whole
I'm so
lot
sorry.
of play. No, that's fine. So the story will actually be a very, it's a very constrained story because it's single project. The company's not planning to do it. So the cash flows are going to be just dispersed every year. Is that usually with oil trusts, you get the entire amount of cash flows just dispersed each year as a dividend. So what they're planning to do?
Yeah.
That's it. You're done. Just discount back at a cost of capital for an oil company, and you'll have the value of the hub.
I have another question. Do you know the company called Diebold Nixdorf? It's they produce ATMs and then counterfeit detectors and anything related to banknotes.
I'm not familiar with it. So where are they incorporated?
New York, in America and New York Stock Exchange. Yeah, NYSE, New York Stock Exchange. Do you think that's an easier option or the teledoc? Because
I think actually your oil hub is about as easy as you can get, right? Because in a sense, there's not a whole lot of play. If you know there are 130 million barrels, even if you don't know the production, the most that'll change is what if you have 5 versus 6. So if you want easy, you can't get any easier than the hub. The ATM, the biggest challenge you'll face is whether people are going to be using cash. And how much
that's true.
Cash, right? That's a big macro question. I haven't gone to an ATM in a year and 3 months.
Yeah.
Because what the heck am I going to do with cash? And that's just not COVID. I don't use cash in most places. I use my Apple Pay. So I think that's a big question with ATMs is, why do we need all these ATMs at people's stuff? And that'll make it more complicated, that macro component, because that's what's going to drive the long-term demand for it. Unless they can find a way to take what they've learned from ATMs and kind of extrapolate it to other ways. But if
Thank
you
you.
want to
Thank you so
go into
much.
that business, I think, much more interesting is a company like PayPal or Square, because that's the future, right? Is if you're interested in that kind of, financial services company, I would go with one of those.
It's because my family business manufactures ATMs and counterfeit detectors. I just wanted to see, and we just exited.
Counterfeit
So
detectors. So basically, it's very cash driven. So there's a big market for it in emerging markets. So it'll be more useful in markets where cash, like India, where cash is still the dominant way in which people pay. So there might be a huge market, but it's got to come with a story of going into those emerging markets.
that's what I thought. All right. Thank you so much, Mr. Professor.
You're welcome. Marco.
Hi, Professor. So I'm valuing a company that is called Orinia Pharmaceutical, and they have a new drug that just got approved by the FDA. The company has been losing money in the past 3 years because they were just spending everything on R&D and raising equity to finance R&D. So the fact is I was estimating the market for this company, given that there is no alternative and it's a $3 billion market per year. And the company virtually has $50 million.
That's the total market, is just 3 billion?
Yeah.
So it's a small company. Because 3 billion is a tiny market still by pharmaceutical standards, right? If you look at markets like for the ulcer drugs, it's often in the hundreds of billions of dollars. So
yeah, it's a really specific drug just for the United States.
So you're not buying a company, you're basically buying a drug then, which is for this particular product. So it'll be like their oil hub, which is it's limited life. The patent runs out, it's your drug basically becomes generic. So it's 15 years of pricing power, total market. You do the cash flows, and then at the end of 15 years, you'll have a terminal value as a generic drug maker.
Okay, yeah, that was my question. Yeah. And also for R&D amortization, I was should I amortize it because they spend a lot of money.
It doesn't matter. It won't change anything. So it's just just keep it simple. Don't get too fancy.
Professor, I had one question.
Yeah, go ahead, Jacob.
Before you go, so for the sensitivity analysis, we should do it based on growth rates.
Whatever you think the variable that most matters in your company is. If it's growth, do it on growth. If it's margins, do it on margins. I'll let you pick, right?
Okay.
Yeah. Pick the variable that you're most uncertain about.
We shouldn't do it on discount rates.
What is that going to tell you? Discount rates are the least of your worries. If that's what you're worried about, do it on discount rates. But who cares about discount rates? How much can they vary?
Okay. Thank you so much.
Okay.
Have a good one.